Markets often feel calm right before the internal balance shifts. This week, price held together, volatility fell, and sentiment improved. But underneath the surface, something quieter may be changing in how capital is positioning. In our strategy, we do not start with outcomes. We start with signals, transmission, and sequencing. That means asking not just what markets did, but why they were able to do it and what conditions allowed that behavior to persist. What prompted this review was a recent weekend macro discussion focused on labor softening, volatility compression, and sector rotation. Rather than repeating the narrative, we want to translate what those signals actually imply inside a late-cycle framework. Labor data rarely moves markets immediately. Its importance comes from persistence. When hiring slows and unemployment trends higher, income growth eventually cools. That feeds into consumption, margins, and later into credit conditions. Markets can ignore this early, sometimes for months, especially when liquidity and buybacks dominate price action. At the same time, volatility compressing is not the same thing as risk disappearing. Falling volatility often reflects positioning and dealer hedging rather than reduced uncertainty. In a late-cycle environment, this can allow markets to grind higher even as fragility builds underneath. That calm can persist longer than expected, but it also shortens reaction time if conditions begin to change. Breadth has improved, and that matters. When more stocks participate, the market gains the ability to absorb negative headlines without immediately breaking trend. This is consistent with a late Phase 1 environment, where pressure exists, but confirmation has not yet arrived. What stands out most is not the index level, but where flows are rotating. Defensive areas like utilities beginning to outperform suggest capital is quietly paying for stability. That does not signal an immediate drawdown, but it does raise Phase 2 pressure over time, even if prices continue to hold up. If this way of thinking resonates, focusing on signals instead of headlines and sequence instead of timing, subscribing here helps you stay oriented as conditions evolve. The goal is not to be early, but to understand the cycle well enough to navigate it with better context and fewer surprises. Yields stalling or drifting lower remove a headwind from duration-sensitive areas, while the dollar becomes a constraint to watch rather than a prediction to trade. If funding tightens through currency strength, global risk assets tend to feel it first, often before domestic markets react. Just to be clear, this is educational analysis, not financial advice. We are discussing macro structure and signal behavior, not telling anyone what to do. Taken together, these signals align with late Phase 1 behavior and rising Phase 2 pressure. Markets can still move higher from here, but leadership, rotation, and confirmation matter more than headlines at this stage. We continue to monitor labor persistence, credit stability, breadth durability, and whether defensive leadership expands. Those are the confirmations that determine whether calm continues or transitions. Our strategy remains simple. We participate conditionally when signals align. We protect optionality when pressure builds, and we let the sequence, not conviction, do the work.